Welcome to the channel. Here, we provide clear, actionable insights into the complex world of tax and accounting to help your business thrive.
All right, let's talk about money, or more specifically, how companies talk about their money. Because believe it or not, that conversation is about to change big time. And I'm not talking about little tweaks in the fine print. We're looking at a major rewrite of the financial rulebook. So let's break down what's new, what it all means, and really why you should care. So you're probably asking yourself, wait a minute, why do these rules keep changing anyway? I mean, accounting is just numbers, right? And 2 plus 2 is always 4. But the rules that govern those numbers, well, they're always in motion. So what gives? Why the constant updates? Well, the answer is actually pretty simple. It's the keep up with a world that's, well, constantly changing. I mean, think about it. Business just doesn't stand still. We've got new tech, new ways of working, huge global challenges, you name it. And if financial reports are going to mean anything, if we're going to trust them, the rules have to evolve right along with the businesses they're trying to measure. Okay, so that brings up another question. Who's actually writing this global rulebook? It's not just some random committee. No, there's a single, very important group whose whole job is to make sure the language of business stays consistent and makes sense no matter where you are in the world. And that group is the IASB, the International Accounting Standards Board. The easiest way to think of them, they're like the global referees of accounting. They create and maintain the rulebook, which is officially called the International Financial Reporting Standards, or as you'll hear a lot, IFRS. This is the playbook that companies in most of the world have to follow. And yeah, they're the ones behind all these big changes we're about to dive into. All right, let's get to the main event. We're talking about the single biggest change to hit financial reporting in more than a decade. And this one is going to change how we look at the most watched part of any company's report. Yep, the bottom line. So the new standard you need to know is IFRS 18, and it is a complete overhaul of how companies put together their profit and loss statement. Let me be really clear here. This is not some tiny adjustment. We're talking about rewriting the foundational rules, the very bedrock that's been in place for decades. So how does it actually work? Well, the best way to think about it is like this. Imagine the old P&L statement was a really messy grocery store. You know, you need milk, but it's next to the light bulbs for some reason. It's just chaos. What IFRS 18 does is it comes in and forces every single company to organize that store into 3 clear, mandatory aisles: operating, investing, and financing. Suddenly, everything makes sense. You can instantly see where a company's profit is really coming from, and maybe most importantly, you can finally compare one company's store to another, apple to apple. And this is way more than just a cosmetic change. It forces everyone to use a new, super specific subtotal called operating profit. Finally, a common yardstick to measure a company's core performance. Oh, and you know how companies love to invent their own fancy metrics for press releases? The ones the rulemakers call MPMs? Well, now they have to show their work. They have to explain exactly how they got that number and tie it back to the official statements. It's a huge step for transparency. And you'll start seeing this everywhere come January 1st, 2027. Okay, so that's the big one, IFRS 18. But beyond that huge overhaul, the rules are also playing catch-up with how business is actually done today. We're talking about everything from complex supply chains to the world of green energy. Let's start with something called supplier finance arrangements. You might have heard it called reverse factoring. It sounds complicated, but the idea is simple. A company gets a bank or someone to pay its suppliers right away. Then the company just owes the bank. It's a super common way to manage cash flow. So what's the big deal? Well, the problem was that these arrangements could kind of hide in a gray area on the books. They could make a company's debt look smaller than it really was, or hide potential risks to their cash. The new rules, which are actually already in effect, are all about dragging this stuff out into the sunlight. They demand a whole lot more transparency. All right, next up, something you hear about everywhere, ESG. And we're not just talking about those glossy sustainability reports. Nope. Environmental, social, and governance goals are now being baked right into the money itself, into the financial contracts. Think about a loan where the interest rate literally drops if a company hits its carbon reduction targets. It's happening. But this created a real headache for accountants. Is it just a regular loan, or is it something else? It's a complex hybrid. So the IASB stepped in with new clarifications to make sure everyone accounts for these ESG-linked deals the same way. The goal is to make sure all this innovation doesn't end up just muddying the financial waters. And here's a perfect example of how these rules adapt to what's happening in the real world. I mean, more and more companies are buying their electricity from renewable sources, right? From wind and solar. Well, that means they're signing contracts where the supply literally depends on the weather, on whether the sun shines or the wind blows. The old accounting rules just weren't built for that. Trying to apply them to these contracts was a nightmare, a real tangled mess. So the ISAB basically said, yeah, this is impractical. And they created a simple, common sense exception. It's a fantastic example of the rule makers responding directly to the growth of the green economy, making life easier for the companies on the front lines of that shift. Okay, so after all that talk about new rules and new complexities, you might be thinking this is all getting more complicated. But hang on, it's not all one-way traffic. There's actually a huge push to make reporting simpler, where it makes sense to. And this is where IFRS 19 comes in. For a lot of companies, this new standard is going to be a massive sigh of relief. It's designed to slash the reporting workload for certain subsidiaries, specifically the ones that don't have public investors tracking their every move. The best way to picture it? It's kind of like a short-form tax return, but for corporate reporting. The logic is pretty straightforward. You just ask 3 questions. 1, is it a subsidiary? Yes. 2, does it have public accountability? Is it traded on a stock market? No. And 3, does its parent company already do all the heavy lifting with the full IFRS standards? Yes. If you get a yes, no, yes, then chances are you can use this much, much simpler set of rules. And on top of all that, there's a push for something a little less technical. It's about getting companies to just tell a better story. The rules for the management commentary part of the report have been updated to really encourage a clear narrative. The idea is to connect the dots, link the numbers on the page to what the company is actually trying to do, its strategy, and where it sees itself going long term. Okay, so we've run through the big changes that are either already here or are right around the corner. So the big questions are, when does all this stuff actually happen? And what are the rule makers tackling next? Let's pull up the roadmap. The new rules for supplier finance disclosures, those are live right now, as of 2024. Then, in 2026, the changes for those ESG-linked instruments and the green energy contracts kick in. And then, the big one, in 2027, that's when the 2 heavy hitters become mandatory for everybody, the brand new P&L format under IFRS 18 and those simpler disclosure rules from IFRS 19. And you know what? The work never stops. This gives us a little peek into what the ISB has on its plate for the future. And wow, these are the heavyweights, some of the thorniest questions in modern accounting. Things like, how on earth do you put a value on intangible assets like a company's brand or its data? How do you properly account for goodwill after a big merger? It just goes to show this whole thing is a constant evolution. And that really leaves us with one big final thought. All of these rule changes, they're not just about ticking boxes. They're part of a much bigger quest, a quest to figure out what financial truth even means in a world where business, technology, and sustainability are all tangled together. It's a pretty powerful reminder that even something as fundamental as the language of money has to evolve, which makes you wonder, what will that truth look like tomorrow?